Howdy, everybody. Welcome to the Liberty Call. Today is Friday, June 6, 2025. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. It's cool, kind of sunny moments, and we got a tornado watch coming through, a warning for my part of the state. So awesome. Excellent news. Anyways, all right. Well, markets ripped higher after May's jobs report beat expectations and cooled recession chatter. For now, remember, like I said the other day, one day everyone's panicking and the next day everybody's in a good mood. So it just depends on what the news is of that day. The S&P 500 closed above 6,000 for the first time, and Tesla bounced back 5% as the Musk-Trump feud simmered down. Meanwhile, Lululemon slipped on a profit warning. Broadcom dipped despite solid AI demand, and Circle's crypto IPO kept flying this weekend's with Wall Street walking tall for now. So before we break all the news down, I need some help from you. Give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, well, let's get to the markets for today and see what happened. Dow Jones was up 1.05%, 442 points, closed at 42,762. The S&P 500 up 1.01%, 60 points, just under 6,000. 5,999 is where we closed, just a half a point off. NASDAQ up 1.2%, 231 points, closed at 19,529. The VIX was down 8.93% today. It's at 1682. Canada up a third, Brazil down 0.01, and Mexico up 0.34. Over in Europe, Germany was down 0.12, the UK up 0.3, France up 0.19, Netherlands up 0.48, Spain up 0.31. Italy up 0.55, Switzerland up 0.39, and Portugal up 0.44. Russian exchanges in the red today. The MOEX down 2.39%, RTSI down 2.44. And the overnight markets, the Nikkei in Japan was up 0.5%, Australia down 0.27, New Zealand up 0.03. In China, the Shanghai was up 0.04. Shenzhen Component down 0.19, China A50 down 0.12, DJ Shanghai down 0.03, Hang Seng down 0.48, and the Taiwan weighted was up 0.26. Good stuff. All righty, well, let's bring up our weekly chart and see how things did for the week. Starting out with the Dow Jones, it's going to be up for the week about 1.24%. The S&P 500 up about, come on, let's catch that, about 1.57. The NASDAQ is going to be up about 2.29%. Dow Transports are up about 1.06. And the Dow Utilities are going to be down by about 0.55. So that's the only one out of the 5 indexes here I have on my little chart that are in the red. So anyways, all right. So all in all, not a huge week, but at the same time, it's a positive growth for now. So we'll see where that takes us. So all righty. Good to go. All right, well, let's get that off my screen so we can get to the economic data that came out this week. Starting out with initial jobless claims, came in at 247,000 against a 236,000 forecast. Previous number was 239. Initial jobless claims came in at, continuing jobless claims came in at 1.904 million. Forecast was 1.91, so better than the forecast. Previous number was 1.907, so down from the previous week. The ISM Manufacturing Purchasing Managers Index came in at 48.5. Forecast was 49.3. Previous number 48.7. Construction spending month over month contracted by 0.4%. Forecast was 0.4% growth. Previous number was a contraction of 0.8. Factory orders month over month contracted at 3.7%. Forecast was a contraction of 3.1. Previous number was 3.4% growth. The job openings and labor turnover survey shows that there are 7.391 million jobs open right now. Forecast was 7.11, and the previous number was 7.2. The ADP non-farm employment change only showed 37,000 in actual. Forecast was 111,000. Previous number was 60, so that was a bit off. The ISM non-manufacturing purchasing managers index came in at 49.9. Forecast was 52. Previous was 51.6. Come on. We stuck. All right, there we are. The trade balance came in at a negative $61.6 billion. But, you might say, hey, that's terrible, Ray. Why would you be excited about that? Well, when you consider that the last 3 months were terrible, prior to that, we had a negative 138, a negative 123, and a negative 130. So this is massive improvement. We're back to levels that we were at, what is that, November, maybe? November of 23. So either way, I imagine that during the quarter, we will be trending back the other direction. So, all right, U.S. non-farm payrolls came in at 139,000. Forecast was 126. Previous number 147. Okay, and last bit of data here: the U.S. consumer credit came in at 17.87 billion. Forecast was 11.3, so a bit over forecast. Previous number is 8.6 billion. All right. So that is all the economic data for the week. I feel smarter. How about you? Yeah. Okay. All righty. Well, let's jump to the market recap. S&P 500 climbs as strong May jobs report eases economic jitters for now. The S&P 500 closed higher on Friday as better than expected U.S. jobs report for May and a Tesla rebound helped lift market sentiment. Non-farm payrolls rose by 139,000 last month, down from the revised 147,000, but above the 126,000 consensus forecast. Despite prior downward revisions to March and April's numbers, the labor market still shows resilience. After hourly earnings also ticked up by 0.4%, stoking wage pressure concerns and signaling that the Federal Reserve may keep rates steady for now. Jeffries noted that persistent wage growth could keep service sector inflation elevated and limit future Fed rate cuts. Tesla shares rebounded after Thursday's 8% plunge, which was triggered by an escalating public spat between CEO Elon Musk and President Donald Trump. Musk signaled a willingness to de-escalate tensions by retracting his threat to terminate SpaceX's Dragon spacecraft program. Trump, however, reportedly has no plans to speak with Musk and has threatened to revoke federal contracts tied to Musk's ventures. Tesla stock is now down nearly 25% year to date amid sliding sales and political uncertainty. In corporate news, Broadcom slipped as its quarterly revenue forecast disappointed investors seeking a stronger AI-driven growth. Lululemon also dropped after cutting its 2025 earnings outlook, citing tariff-related pressures. DocuSign fell due to slower than expected Q1 billings growth. In contrast, stablecoin from Circle extended gains following its recent market debut, with shares having doubled in value over the past 2 sessions. All right, that's everything there. Let's get to a data report. The May employment report via First Trust and our friend Mr. Robert Stein. Let's get my summary up here. May's labor market report delivered a mixed message, with the headline non-farm payrolls figure beating expectations at 139,000 jobs added versus the 126,000 forecast. Largely downward revisions of 95,000 to the previous 2 months softened the impact. Net of revisions, the labor market only gained 44,000 jobs. A closer look at, quote, core payrolls, end quote, which excludes sectors heavily influenced by government, which are education, health services, and leisure and hospitality, reveals that just 5,000 jobs added in May and only 26,000 over the last 3 months. That is not good. Civilian employment, a broader, more volatile measure that captures small business activity, plunged by 696,000. The employment rate held steady at 4.2%, largely due to a 625,000 person drop in the labor force. Over the past 4 months, the labor force has shrunk by 234,000, with declines in the foreign-born segment, possibly linked to immigration policy shifts under the new administration. Hey, that's some good news. People are self-supporting and opening up jobs here for us domestically. Notably, federal payrolls, excluding postal and census workers, dropped by 16,000 in May, the largest monthly decline in 2 decades. Since January, these jobs have fallen by 47,000, reflecting the administration's efforts to shrink government, a move that could stimulate future private sector growth. So let's hold on. They've only laid off 47,000 government workers have quit. So 47,000 let's just say there's 2 million federal workers. I know that's in the ballpark. That's only 2%. We could easily slash, 80, 90%. Wouldn't even notice. So, alrighty, where was I? Average hourly earnings. Average hourly earnings rose 0.4% in May and are up 3.9% year over year, signaling healthy wage growth. However, this wage pressure may deter the Federal Reserve from cutting interest rates in the near term. Meanwhile, the share of unemployed workers who voluntarily quit fell to 9.8%, a 4-year low, indicating rising caution among workers about job security amid economic uncertainty and tariff-driven volatility. Okay. All right. One more article here to cover before we get to the weekend. Comes from Zero Hedge, and it's titled, Does Consumer Spending Drive Earnings Growth? This was authored by Lance Roberts via realinvestmentadvice.com. All right. Wall Street's current forward earnings forecasts appear overly optimistic, especially when evaluated against historical trends and the reality that consumer spending is the primary driver of economic and corporate earnings growth. According to Lance Roberts of realinvestmentadvice.com, S&P Global estimates have projected earnings far above long-term exponential trend, which is unsustainable. Historically, earnings have repeatedly reverted to their trend line during economic shocks, like the dot-com bust, the financial crisis, and COVID, highlighting the vulnerability of earnings to macroeconomic pressures. Earnings are derived from revenue, which depends on consumer spending. Personal consumption and expenditures, making up nearly 70% of GDP, strongly correlate with forward earnings, as does consumer sentiment. Declining confidence due to tariffs, inflation, and economic uncertainty can lead to reduced spending and weaker earnings growth. However, Wall Street often masks declining earnings quality through cost-cutting, accounting tricks, and massive stock buybacks. While these tactics may boost short-term earnings per share, they distort valuation metrics like price-to-earnings ratio and EBITDA. Roberts emphasizes looking at less manipulated metrics such as price to sales or EV to sales for a clearer valuation picture. Corporate executives are increasingly incentivized to maintain stock picks, which has led to widespread earnings manipulation. A survey cited by Roberts revealed CFOs believe earnings can be misrepresented by up to 10%. Investors should focus on fundamentals, transparent revenue growth, diversified portfolios, defensive sector allocations, and careful monitoring of consumer sentiment and PCE trends. Earnings projections that ignore these realities may be misleading. In a world where consumer strength drives economic performance, understanding the financial condition and behaviors of consumers is crucial for anticipating future market performance and protecting investment capital. I agree. All righty. Good stuff. Hope everyone enjoyed these articles for today and for the week. All righty. Well, if anyone needs to get in touch with me and needs to get their financial crap in order, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help. Okay. All right. Well, everyone out there, I hope you have a wonderful weekend, and I'll talk to everyone again next time. Adios.